Okay, so let's go ahead and get started with the second quarter outlook and performance review for equity funds. And as you guys are going to see, this is really somewhat reminiscent to what we saw in the fourth quarter of 2000. Just finished. Basically, we saw two really kind of cruddy months, followed by one fairly strong month, that being June for us. And usually, I go through kind of a detailed piece, as a quarter at a glance. And this is a really busy screen. I'm not going to do that this time because really we know that the global and economic uncertainties that were out there, accompanied with the U.S. Slowdown in our economic growth. And again, it's about neutral. We're actually seeing things that are looking okay, but maybe not strong enough to keep people happy, basically was the main focus of investors during this piece. And our main issue that we had in all three months was basically debt. Primarily looking at Greek, Italian, and Spanish debt, and then also looking at payrolls for the United States. We were disappointed by payrolls in April, in May, and then again in June, when we're reporting the prior months. And in fact, we just heard yesterday as well that payrolls came in fairly weak on Friday for us as well. So we've had kind of disappointing, but again, it's been positive news as far as non-farm payrolls. Again, it's just been missing expectations. So again, the three primary movers has been poor payroll, or at least lower than expected payrolls. Basically, bad news from Spain and Italy and Greece, and then also China's slowing economy. And as we can see, the first month we had in April, only about 26% of all equity and mixed equity funds were in the positive. We followed that in May by having only 3% and actually suffering one of our worst one-month performances, actually in 9 months, down 7.57% in May for all equities and mixed equity funds. And then in June, finally, we saw some good news basically come out. And we were talking about China actually cutting its interest rates for the first time since 2008. We'd been hearing about them actually loosening up the requirements for capital requirements on their banks, but now they actually came out and cut interest rates. And in fact, just recently, they did a second cut as well. So that was actually encouraging. We see the central bank actually standing ready to help, central banks on a global basis stand ready to help out the economies and prop up their economies. So this was all pretty positive news and really helped us move to what was going on. We saw the Dow actually post a 3.93% return in June. It was the best monthly performance of the year so far. So again, things were looking up, even though we had, again, disappointing non-farm payrolls. The actual unemployment rate stayed at about 8.2%. We seem to be stuck, but it's not a horrible place to be stuck. It beats 9 or 10% unemployment rate. So again, things were good. Well, let's go ahead and move on now to kind of what happened for the quarter of 2012 for equity funds. Basically, we saw that for the quarter, only 8 classifications out of Lipper's 86 classifications for mixed equity funds saw positive returns, with the mixed asset funds basically pushing up the best performance, 2.34%. And I don't think it was actually very surprising for us to see that the European funds, or actually I should say world equity funds, were the biggest losers. When we saw that there was a European debt crisis, it was continually on our mind, very myopic focus that we had, along with a strengthening dollar throughout the quarter. In fact, if we take a look at the dollar, it declined against the yen 3.05%, but gained against the pound 2.64%, and against the euro 6.08%. So that, coupled with this concern of the deepening global debt crisis in Europe, certainly was not surprising to see world equity funds post the worst performance, down 7.17%, and only 9% of all equity and mixed asset funds were in the black. Now, if we take a look at who the winners were, obviously dedicated short bias funds, when we have something that's down, we expect the bear-oriented funds to do well. But really, maybe a surprise was how well we had dividend plays and defensive issues do. And we'll see this as a theme as we go through our presentation. Real estate funds up 3.39% for the quarter. Utility funds up 2.53% for the quarter. And health biotechnology funds up 1.84%. So again, this was something that we saw, and it was a continuation of what was going on. Now, one of the big stories I think that was out there, of course, gold lost a little bit as well. But when we get down to after the gold, we look at oil. Oil lost 17.53% of its value. It went from $103.02 down to a closing price of $84.96 a barrel. So that was quite a loss, and we're going to see that reflected through sector funds. Overall, though, this is a quarter-date review. Year-to-date, we're still up 6.05%. So all the naysayers that are out there, we still have a fairly strong performance as well. Let's move on to the United States Diversified Equity Funds, where part of the story was told by, basically what was first was last was first concept. Basically, last quarter, Diversified Leverage Fund was the big gainer. We had dedicated short bias funds and emerging market funds at the bottom. And basically, the growth-oriented issues were the cat's meow in Q1. Well, Q1 basically was flipped on its side. We got people running for value, people running for income distributions and the like, and basically ignoring and shunning, if you will, the tech and growth-oriented issues. And that's certainly a story that we've seen here. The diversified leverage, we now call equity leverage funds, were the biggest losers, losing 10.40%. Again, when we have extreme moves either way, we usually find them at the top or bottom, and we see that when we look at the June returns as well. June, very, very strong returns. We saw the equity leverage funds up 8.22%. But here's where the change starts to begin. Our next big winner was large cap value funds, earning 4.26%. And of course, equity market neutral and dedicated short bias funds were at the bottom. Year to date, this group is up 7.03%. So it's been, again, a pretty strong performance as far as year to date performance goes as well. If we take a look at this, and then we see where I highlight the particular groups, growth-oriented funds, again, are what took it on the chin. And if we look up towards the top, basically we start looking at kind of value and core, and anything that was not growthy related actually did better than the other groups. So this was really one of the stories that we saw. And growth-oriented funds were down 5.69%. They were up at the bottom of the group for the first time for the first quarter in 4. So this is kind of a change that we've seen as of late. And here's a detailed picture of what we saw as far as the returns go. For the second quarter in a row, we saw large cap funds actually outperforming. And of course, when we have difficult periods where we're seeing, again, maybe some global conflict, financial crisis going on and the like, large cap funds, people have a tendency to flock. So they mitigated losses better than the other groups, 4.56%. And again, it's the second quarter in a row that we saw that. But here we saw core funds actually outpace both growth and value. And I think this was to be expected. Again, value was more of a play. Certainly people were shunning the growth-oriented issues. If we take a look at monthly, we have a little bit of change, and this is what I was talking about. So for the 1 month, for the first month in 6, we saw small cap funds rise to the top of the pack. They seem to be the area of focus people wanted to put money back to work in. I'm not sure how flows did. Matt will talk about that later, as maybe small caps, but certainly we saw performance do better. And then on the value side, we saw the value side for the first month in 7, where value beat their core and growth-oriented cousins as well. So moving on to the sector equity funds, this is where we're going to see kind of a real mixed bag. The sector equity group actually housed 2 of the 3 largest losers of the universe, but it also contained 7 of the 8 winners for the quarter as well. So it was really a mixed bag. It was the second best performing macro group for the quarter, down 4.2%. But when we talk about this, remember I told you that people were paying attention to dividend players and defensive plays. Here, real estate funds were up 3.39%. Utility funds added on 2.53%. Health biotech funds had 1.84%. So this is something that we saw there. Now back to the big story I was saying. We saw gold, we saw other natural resources down. Well, guess who got clobbered? Gold was down 13.44%. Global natural resources were down 11.73%, and commodities base metals, that's the CMM, was down 10.12%. But as we turned into June, we saw the numbers actually increase, up 3.58%, second best performing group of the macro groups. But here we saw the commodities, agriculture, actually putting on some good numbers, 8.34%. And again, the dividend players I was talking about, international real estate funds up 7.36%, global real estate funds up 6.26%, and we got the commodity specialty funds being the laggard. Now, commodity specialty funds, we've shown on a couple of these slides, the CMS. Basically, these are the guys that are either long or they're leveraged, or they're dedicated short bias focused type of a commodity fund. So we usually see them kind of in the extreme areas. Specialty funds lost about 0.77%, and then again commodities base metals we're down 0.69. Year to date, this group is also up 4.83%. I think that's kind of amazing considering how badly we saw crude oil get crushed. Taking a look at the group as a whole, basically we can see where the big winners were. Again, remember I told you that the dividend players and the defensive issues were doing best. If we take the commodity specialty out of there, remember I was telling you that's either short bias or leveraged, and we take a look at the top, real estate utility funds, health biotechnology, global health biotechnology, and then international real estates. All these funds had positive returns, and again, investors preferred the dividend pay, or again with health, maybe not the biotech, but health, doing better in kind of clumsy times. It's kind of a sticky group to be in. And in addition, we heard some news about the Supreme Court. Supreme Court basically came out and said Obamacare was constitutional and could be used as a tax. And so I think this was a positive move as well. So we saw those type of things. So again, accepting those, the 7 big groups here of the winners, 7 of them actually belonged, again, if we took out a whole group, 7 of the 8 positive returns came in the sector equity funds grouping. So taking now a look at the world equity funds, again, it's looking at the poor global outlook, the China slowdown that was reported, the U.S. dollar strengthening, investors pressured world equity funds. Again, it was ranked 4th. It was at the bottom of the barrel. This is the first time, this is a third quarter in 4 that they were at the bottom of the barrel. But when we turn around and look at the monthly returns, it ranked number 1, and basically what was at the bottom got pushed to the top as we're taking a look at it. So if we take a look at the winners for the quarter, basically, again, this was global and developed market type of plays. So we had the global large cap core mitigating losses, 5.1 minus 5.12%. Pacific region funds down 5.56%, and Japanese funds down 5.70%. And at the bottom, we saw the individual countries and the true international plays, Latin America down 12.32%. So it was really kind of a fine line. You'll see that in 2 slides when I show you another piece as well. But at the top for June, we saw India region funds up 7.63%, and the beleaguered European group up 6.39%. So they certainly did better as well. Year to date, this group is up 4.46%. Before I move on, there's a little bit of a talk on that. We know that the dollar lost ground against the euro, but it basically gained against the yen. So against the euro and the pound, we lost it. So there was a change in attitude. Again, we saw China come out and cut rates. That was one of the primary reasons. I think we saw good news here. Obviously, we've been hearing about the Brussels summit. We've heard some fairly good news about that. I think that's been on again, off again, so people really don't believe it until things are done. But then we saw a weakening of the dollar, and I think that's what helped in June, moving into positive and strong territory at that. So moving on and looking at the group, basically, again, for the quarter, investors pressured the small mid-cap groups. We see them at the bottom, 7.44% and 6.93% if you're looking at both the international and global diversified matrices that we put up here. Best performing groups for the quarter was the large cap groups, and of course, core was able to mitigate losses better as well. And something I don't have in the slide for June, large cap funds really set the pace for both of these groups. And on the international side, we saw international funds return 6.01%, and we saw global funds return 4.57%. So as we take a look at this, and we take a look at who the winners were and who the losers were, remember I told you there was a distinct line. Those that had a little bit of U.S. focus, that were more developed nations type of categories were at the top of the group, again, able to mitigate losses better than their international and single-focused or region-focused cohorts. So we see Latin American funds at the bottom, emerging markets at the bottom, India region funds at the bottom. So then we get down to the mixed asset funds, and this is the one I always want to bring up because we've been seeing a lot of money come into this category. It was the number 1 performer at mitigating losses for the quarter, down 2.35%. And so it was the number 1 out of all the macro groups, the USDE, world equity, and sector equity funds. But we wanted to kind of point out why we always bring this issue up. Basically, year to date through June 30th, United States diversified equity funds have seen about $43 billion in outflows. Whereas if we take a look at sector equity funds, they've seen about $6.7 billion in inflows. World equity funds have taken in about $20.1 billion in inflows. But the big behemoth, the big attractor of assets, has been mixed asset funds, the set it and forget it type of allocations. They've seen $63.4 billion in net new money come into the group, bringing the net flows into equity funds at $47.2 billion on the positive side. And as you can tell, if it hadn't been for world equity mixed asset funds, we'd be in the negative as far as returns. Let me give you the returns here. We saw mixed asset target allocation conservative funds. They basically were down 0.28%. And at the bottom of this group, target 2050 plus funds were down 4.12%. Well, that brings us to my final piece as well. And basically, it's hard for me to be either a bull or a bear in this market. And the reason I say that is we have a lot of different things going on. Let me share with you some of the concerns that I've been taking a look at. Obviously, the lower than expected June payroll that just came out, 80,000, stuck at 8.2. I actually have that as a positive because it's stable at 8.2 as well. So we didn't lose ground. Now that's not enough to actually make up for the new job entrants that come into here. So there is some concern, but again, we're not seeing negative numbers or lower numbers than we have there. The global issue we've already discussed: European debt and China's slowing economy. All eyes are really going to be on. We heard reports today that the Brussels group got together and basically said, hey, they're going to give Spain some time, let them actually extend how much debt they can have out there as a percent of GDP, and they're going to try to make it so there's a little bit more room for them to maneuver. That was good news, but equally people want to know who's going to have to pay for this. The Germans are very concerned. Of the 17 nations that are in the euro, who's going to have to pay for it if we finally have a default? Those are questions being asked right now. One of the big things that Thomson Reuters proprietary research team has been kind of touting is the increase in negative earnings per share pre-announcement for Q2. And this has been something that's been a little bit larger than we've seen. In fact, it's the worst rating for ratio of negative to positive pre-announcements that we've seen at 3.3 since Q4 of 2008. We had 95 negative earnings per share pre-announcements so far in Q2 compared to 29 positive earnings per share announcements. And again, that negative positive ratio is the worst that they've seen on a quarterly basis since Q4 2008. So that's a little bit discouraging. The ISM Manufacturing Index declined to 49.7. It is the first time that we've actually gone into a contractionary signal since mid-2009, so that's of concern. However, if we take a little bit closer look to the ISM numbers that came out, the employment index only fell slightly and still is presenting a very strong 56.6% or 56.6 as far as the number goes, and that would indicate that we're still in an expansionary phase from an employment point of view. Now, one of the things I always provide is Lipper flows, and this is ex-ETFs. This is year to date. Basically, I'm still a little discouraged at where investors are going, and this is maybe some of the reason why we're not propping up equities. Equity fund flows, as I told you in the last slide, it was up $47.2 billion. Fixed income it keeps attracting hand over fist money, 147.3 billion, and money market funds have seen 177.8 for a grand total into the conventional fund business so far of $16.7 billion, which is a very small amount. Matt's going to go into greater detail in this a little bit later. But if we again take a look at the positives that are out there, the ISM non-manufacturing index fell to 52.1. It's still signaling an expansion. We saw personal income on the rise, and again, I come back, job payroll is on a positive, up about 80 million, up about 80,000. And still is stable at 8.2%. But the next 2 points are probably my biggest thing of why I can neither be a bear nor a bull. We have these problems I just talked about, but China cut its interest rate for the second time. They've also been messing with their reserve requirements for their banks. This has been a positive thing. You may give them some breathing room. We heard that their inflation rate wasn't as high. Just came out yesterday. It wasn't as high as they had previously thought. And the global central banks are standing ready to help. And we have a global concerted effort by the central banks to make sure that if there's if something goes wrong with the Greek vacillation of whether they're going to stay in the euro or whether we have Spain or Italian debt having problems, it looks like the central banks are ready to stand, ready to do just about anything they can to keep the economies afloat. So again, while I'm not real sanguine on the situation, I'm not real bearish either. I'm neutral, and it's not too unusual approaching the dog days of summer, which will be coming up, that this type of situation, we're kind of in kind of a ho-hum situation, kind of standing pat. Well, that's it for me. I'm going to go ahead and pass this off to Jeff Turnahoy, and he'll be able to talk to you about the fixed income. performance.